Hello there, this is James and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Wednesday. In today's program, I want to talk a little bit about obviously the major event which is happening in a couple of hours' time, and how the market is sort of basically holding its breath for this event, and sort of have an open conversation of some of the implications this event could mean to the market, plus a couple of other new developments as well, which has occurred so far today. But before we get into all of that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out the way, let's get started. So, of course, we all know what I'm going to be talking a little bit about this afternoon. And that is, of course, the Fed interest rate decision, which is due in a couple of hours' time. And this is why, for example, we're calling today Fed Day. Now, first of all, I want to sort of ask a couple of little questions, because this is quite interesting in some ways, is that the Fed is acting a little bit like the Brat Pack. What do I mean by that? What do I mean by that? What I mean by that is basically the Fed hasn't done this type of tightening policy since the 1980s, which would sort of make sense. Because we haven't seen inflation at these levels since the 1980s. So it would make sense for the Fed to be tackling the issue since then, or in the same way as they tackled it back in the 1980s. But my question is the economy or economics, how we operate nowadays, isn't it slightly different from the economy of the 1980s? In some ways it is, in some ways it's not. But there is a danger, because I think the general consensus is that the way the Fed is acting, and they haven't hidden behind this, is they're happy to push the US into a recession in the name of fighting inflation. So they're happy to have a recession. They've even said, not just Jay Powell, but several members have said they're happy for the labor market to soften. And they've even also said as well, we know households are going to suffer because of the actions they are doing. They are aware of this. And unfortunately, they've also identified, but it's the households who are struggling the most who are going to suffer the most as well. But like I said, they're prepared to do this because they want to bring inflation down to 2%. They're absolutely committed to this. And again, on several other videos I've done, I often ask the question, when we've had quite a bullish momentum in the market, are the market kidding themselves? Because whatever you do not fight the Fed. But there's several reasons why the market has been like that in the past, because they are convinced at some point the Fed will stop raising interest rates and will start to decrease interest rates. But the Fed is not saying anywhere or dropping any hints of that could happen at all, certainly by next year as well. But anyway, the countdown begins, because this is the big event. This is the event the market's been waiting for. Okay, so the countdown has begun, and it's going to be starting off, obviously, the Fed interest rate decision, which is expected at 6 p.m. UTC. Okay, and we'll talk a little bit about what that rate could be as well. But at the same time, and I think this is going to be really interesting, at the same time, they're going to release their Fed monetary policy statement, and their economic projections are due at 6 p.m. UTC as well at the same time. And it'd be interesting to see their view or their projection on inflation. Okay. Bear in mind, last week's inflation reading did come in higher than anticipated. It was announced at 8.3%. This is headline inflation, 8.3% versus the expectation of 8.1. So it'd be interesting to see how or what their projections are, especially with the core year on year. That came in at 6.3% as versus to the 6.1% expected, so higher as well. And bear in mind, the last reading on core was 5.9. So it'll be interesting to see the projections on this. But Anyway, the overall market is priced this in, and we'll talk a little bit about how the market could react. Basically, the market is priced in 80% chance of a third straight 75 basis point rate hike by the Fed. So that's the third time. So they're pricing in 75 basis point rate hike, okay? And only a 16% chance of a 100 basis point rate hike. Only 16%. They are really pricing in 80%. I think the market has basically assumed that they're going to do 75, myself included on that. I mean, the idea, it did bounce around that the Fed may be super aggressive and do 100 basis point rate hike. This was on the back of the CPI reading last week. But since then, that anticipation for 100 is dropped down. So now the market is pricing in 75. And my anticipation here, or my anticipation with this, because it's priced in already, if they are to do a 75, we might potentially see a small bounce in the markets as it's priced in. And we might see that. And as it is, the stock market in general has opened so far a little bit higher so far as we build up to this. So like I said, the market has priced in 75. If we do see 75, we might see a small bounce, but I don't think that bounce will last particularly very long. And the reason why I say that, and this is also another point which I mentioned a little bit this morning, and I want to talk a bit more about it today, is that I feel is what they say is more important than what they will do today. Okay, because 30 minutes after the interest rate decision, we'll have the FOMC press conference. Okay, and as you know, I've covered interest rate decisions a lot, and I do a lot of watch-alongs for interest rate decisions. But I always say it's the press conference was where you could quite often see the fireworks really begin, because it's going to be his tone of what Powell says, what was behind the decision-making process, how they see the job market in the future, how they see the economy in the future, how close they think the US are bordering or on the brink of going into recession. Because don't forget, last time they did it, okay, the market made a mistake. They took his comments, and the same with this, they did the same mistake with the FOMC minutes as well. The same mistake with the FOMC minutes, and I covered that. I did a special from home because it was a late night event, and I covered that. And I was trying to digest it at the same time. It's an 18-page document, so we were trying to dissect. We were trying to dissect it live on air during that episode. And the last time with the FOMC minutes and with his press conference, they took him slightly dovish initially, and so obviously you saw a bounce in the market. But then as people reread it and then really digested what was said, they realized he was being the hawks of hawks, and then the market reversed. So we might see something similar to that. We might see the market accidentally misread what he says and initially believe he's being dovish, and we might see, like I say, a market bounce until later, or till a couple of sessions, maybe the next session, the next day, for the information to sink in and actually realize, hang on, he's still being extremely hawkish. And here's the other thing. This is what they're gonna try and ask him, and maybe put him in a situation to see if he can confirm this. If they do another 75 basis point interest rate hike, then it would be the interest rates would be at the highest level since 2008 at 3.25%. 3.25%. And then the question you have to ask, and the question which will be put to him, is how high can they go with interest rates? How high can they go? And in fact, Goldman Sachs believes that interest rates in the United States by the end of the year will go between 4% to 4.25%. Okay, 4% to 4.25%. And don't forget, I did a video, I think it was last week, on a billionaire investor. He warned, if interest rates go anywhere above 4%, then the market could lose as much as 20%. So that's his opinion, obviously. But obviously, he's a billionaire investor, so he must have a good grip of our understanding of the market. And this is the other thing, and I'm going to quickly talk about this other data which should come out, because this is linked to that in some ways. Okay, and I've talked about this a lot on my videos, because I think this is a story waiting to happen. I really do. Because don't forget, obviously, with interest rates, it affects the housing market. And today, okay, we had US existing home sales. And these are, not new builds. These are buildings which have, been built for quite a while and been sold on. Okay. Now, this figure, okay, is initially, this is the number of properties sold, came in at 4.8 million versus 4.7 million expected. So better than anticipated. So sort of showing signs, okay, the housing market is, is holding steady. However, when you look at the change, housing market, the change, it was actually negative 0.4%. And that's the 7th straight monthly decline in existing home sales. So yes, the number is slightly better, but the percentage, the change in the number of existing home sales compared to the other month is negative 0.4%. So a 7th straight monthly decline. And like I mentioned, why I talk about this, if indeed by the year's out, okay, interest rates are at 4 to 4.25%, how much damage is that going to do to the housing market? Okay. And don't forget, I did another video last week when I discussed the housing market again, because I talk about it a lot, because I think the market and other analysts aren't talking about it so much. I think it's a story waiting to happen. I really do. Okay. Like I said in another video, the actual overall household income now to pay the mortgages in the US is 35.6% of entire household income is needed to cover those payments. In January, it was only 24.7% of household income was needed. So anyway, there's a study. But anyway, look, there is something else I want to talk about in a minute. But let's have a quick look at the market and see how it currently stands. Let's start off with the dollar yen. Okay, let's have a look at dollar yen. Again, not much change from this morning. We're still seeing a lot of dollar strength. Currently trading at 143.97. It's still got a bit of way to go yet. It did try to break through 144 today, and it has touched it slightly, but didn't manage to remain above it. And like I say, I think, again, like I said this morning, unless the BOJ does something in particular, it's only a matter of time till we see testing 145 again. So, and again, of course, it does depend on how the Fed react tonight as well. 75, again, like I say, might see initial market boost, so might see initial dollar weakness. But let's say if the Fed does a complete surprise and does 100 basic points, then you will see a lot of dollar strength, but I doubt they do 100. If we look at the cable, okay, the cable, again, still very much under pressure, very little change from this morning. Don't forget, I talked about some other financial data coming from the UK today. And those who watch me, they know I'm pretty bearish on the sterling US dollar. Currently trading at the moment 113.34. So yeah, still way under that trend line we put in during that hashtag Ask James episode. Gold, okay, if you look at the 30-minute, okay, initially had a little bit of a shine to it because of the safe haven status, especially to what happened with what Putin announced this morning. But for now, again, we've got dollar strength against it. Currently trading $1,669. Really, that level there, $1,667, is the first area I'll be keeping my eye on for a potential support. But like I say, if the Fed is really aggressive, then that probably won't be a very strong support at all. But so it'd be interesting to keep a very, very close eye on it. The market, like I said, is open slightly with a little bit of a boost today. S&P, as we wait for the Fed decision, because as like I said, I think we got the 75 basis point priced in as it stands. Currently trading at 3,880 points. So slight bounce with that. The Nasdaq is the same. Again, slightly open, slightly higher. Currently trading 11,899 points. And obviously, if we have a look at Bitcoin as well, we're back above, 19,000. Currently trading now at $19,350. So again, got a teeny weeny little bite of risk appetite. Not a massive one, just maybe a little nibble of risk appetite at the moment as we wait for the Fed. Now, I want to look at another currency pair. Before I go into that, though, I want to talk about something else which came out today, which I found quite interesting and pretty much very foreboding, to be honest. And that is Deutsche Bank, okay, has slashed its EU GDP forecast for 2023 down to negative 2.2%. Now, their forecast for the EU GDP for 2023, the forecast they did in July, that was negative 0.3%. So that is very much dramatic, going down as low as negative 2.2%. And this is what they had to say. This is one of their analysts, Jim Reed. Okay. He said the energy crisis in Europe means that 2023 will likely be behind only 2009 and 2020 as the worst year for the European economy since World War II. And you couldn't say that then. But let me read that to you again one more time. So he's saying, in their opinion, because of the energy crisis, the economy of the EU in 2023 will be one of the worst, and will share the worst year along with 2009, 2020, obviously, because of the lockdown and and COVID. But it's going to be the worst since World War II, only with 2009 and 2020 being similar. So that's pretty frightening. Let's have a quick look at the euro, because the euro has been obviously under a lot of pressure. We know it's been under parity. It's now way under parity. It's now currently trading at 0.9891, so even below the 0.99 handle. So below that handle now. And like I said, I've often been long with the sterling. I've been a euro bear as well. And like I said, I think there's a lot of stuff coming in which is not helping the euro at the moment. So yeah, the euro is under pressure, and this is just something else now which has got to weigh heavy on the shoulders of euro bulls. That sort of that decline in GDP forecast by Deutsche Bank. So again, pretty scary stuff. So yeah, I have to look at that. But like I say, we'll have to see how it reacts with the Fed if they really do surprise us. Other big events coming up, of course. Bank of Japan, which I believe is tomorrow, and they're not going to do anything. US interest rates, which is happening tonight. UK interest rate decision happening tomorrow. I will do a watch along for that. And EU manufacturing and services PMI happening on Friday. The market, as it currently stands, like I said, slight boost on it as people are waiting. We got Euro stocks currently trading in the green, 0.41. FTSE currently trading in the green, 0.24% higher. DAX currently trading in the green, 0.20%. So yeah, it's all about the Fed again today, and let's see if they surprise us, or I think we all accept it's going to be 75. I will just be more interested in the projections and the press conference which follows, because I think that could potentially be where the fireworks is. Because again, like I say, will the market kid itself, or will the market wake up to reality? So we'll have to wait and see. Don't forget, you can ask me questions anytime you wish, or simply say hello if you like. Or share with me your opinion, what you think is going to happen tonight, or what you think the outcome. I mean, or what do you think about what Deutsche Bank said about EU GDP? Which I find really, I find nothing but bad news at the moment, especially when it comes to the Eurozone and things of this nature. Very, very little good news to be happy about. But anyway, not a problem. Don't forget, if you think of a question later, you can put it in the comment section, either on Facebook or YouTube. I will see them, and I will answer them next time I go live on air. So don't forget, you have that option as well. And I have done many times. I see them, and I will always answer. I would always answer any question, as long as I know the answer, of course. Okay, not a problem. If there is no questions, not a problem. Not a problem. Don't forget, I'll be back online again tomorrow. I'm actually be online 3 times tomorrow. I'll be on at 8 a.m. UTC to cover the European session. Then again, to do a special, I'll be on at 10:50 a.m. UTC to cover the Bank of England interest rate decision. That I think is going to be really big, along with their press conference as well. And their monetary statement, that comes out at the same time. So that's going to be a really big event. That's going to be quite exciting. Especially, like I said, with the amount of pressure on the sterling at the moment. And I've often said, don't forget, I think the Bank of England are really in a rock and a hard place. It's be interesting to see that. So please come and join me in that for the watch along. And again, tomorrow at 2 p.m. UTC to cover the US session. So please come and join me if you can. On that note, if there is no other questions, not to worry. If you're watching me on Facebook, don't forget, if you've enjoyed this little episode, give us a follow. If you're watching me on YouTube and enjoyed this little video, etc., subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and found it interesting and you put up with me, my overall top enthusiasm for the market, which I simply cannot help because I love the markets, then give me one of these. It's nice to know that you like what I do. I can see I've got a couple of likes already, which I really appreciate. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.